Treasury yields jumping today off the back of inflation data that showed further cooling in the market. The PCE price index increased less than 0.1%, boosting sentiment on Wall Street that the Fed will continue to hold rates steady. Here with a deeper dive on this is Rob Haworth, U.S. Bank Wealth Management's Senior Investment Strategist. Rob, thank you so much for joining us today. Listen, we did get a lot of important economic data today, Rob. So consumer spending, inflation seems to be showing some cooling, adding this conviction, Rob, that, listen, Jay Powell and our central bankers are done hiking, that cuts are in the pipeline. Is that your view, Rob?
Yeah, no, thanks for having me. So our view is the Fed's probably on hold into the middle of the year. I think the key is still how the data evolves, right? Even though we saw inflation slow a little bit more, I think the challenge is it's still somewhat elevated, and we really need those shelter costs to come down and some more signs that the labor market is slowing. We're getting some, but it's not slowing very quickly. So I think we need a lot more data for the Fed to really feel comfortable before they maybe consider cuts maybe at the middle of next year, but it's going to take some time and a lot more data.
So speaking of the data and the PCE data that came out today, it does show that it seems to be that we're on the right track. How do you think the Fed reads this, Rob?
No, I think they definitely read it as on the right track. I think as we get into December, our expectations would be they don't need to make a change here in December. And obviously, after the December 13th meeting, we'll all be paying close attention to what they say, as well as their dot plots and how they think the economy evolves. But for now, the market's thinking it's 4 cuts in 2024. That seems a little aggressive based on what we know so far for economic data, which has been surprisingly strong if we think about 2023. And it will take an awful lot of cooling, maybe a recession, to get the Fed to start to move towards cuts later next year, which is not necessarily great news. And by the way, I should be clear, not really our base case. We think we can narrowly avoid a recession next year.
So Rob, you seem to be implying that you're in the soft landing camp there for 2024. You think inflation returns that 2% target without a downturn?
Yeah, I mean, for now, and this is really coming from our economics team at U.S. Bank, which does a fabulous job evaluating the consumer remains surprisingly resilient. I think even if we look at the personal consumption expenditure data that just came out, their spending is holding up okay. Yes, they're still preferring services over goods, but we're not faltering too badly yet, even though we did see the start of student loan repayments. Yes, mortgage rates are still elevated. Housing activity is a little slower, but the consumer seems to be able to weather this storm for now, and we may be able to move through this without a lot of damage to the economy.
Rob, I want to pivot a little bit from the economy to equities and get your take on where things stand now in terms of the market movement, some of this Fomo trade that seems to be happening. What is your view on what's happening? Is it a catch-up trade?
Well, yeah, there's certainly been some of that. If we take a look at smaller companies, at utilities here lately, as we look at it and we look at the broad S&P 500, we think we're still in what we've termed the chop, right? This is a market that is really looking for direction one way or the other, whether it is recession, it is Fed rate cuts on the horizon, or are we past this earnings recession and earnings are really going to be quite strong headed into 2024. So we're seeing the S&P 500 is kind of bound between, say, 4,150 on the low end and 4,600 on the upper end. And until we get out of that range, I think it's a lot of uncertainty and back and forth. I'm sorry, go ahead.
No, go ahead, Rob.
Oh, yeah, no, I think as we look at it, there's certainly some value that's arisen in the market as we take a look into 2024. We've seen utilities, defensive companies, financials, healthcare, a lot of sectors outside of those growth sectors like technology and communication services, which have been left behind and may have some catch up to do in 2024. But it's hard in the long term to really discount those growth-oriented companies because this is an economy where fast is getting faster. Artificial intelligence, cloud computing, software, data security are all major factors as we think about spending moving forward over the next 2 or 3 years.
And Rob, you're also a fan of oil here?
Well, it's something we're really considering as we look ahead. I think the challenge for oil is global demand. We really need global trade to kind of rebound, and that soft data coming out of China and Europe is not good news for global trade just yet, nor for global oil demand. But as we get through this winter season, there's a lot of support to think about when it comes to oil, particularly because inventories here in the U.S. remain low, and we're not necessarily positioned for to meet that ramping demand should the economy start to improve.
And then what are the catalysts that you're looking for to really be off to the races in terms of the economy that changes kind of your perspective on where equities are and where they're headed in 2024?
Yeah, great question. I think if we can get past this inflationary pressure and get kind of back to a normal economy, that will help. That means, we kind of work through. I mean, it's kind of unusual to think about a soft landing without a recession because you don't get that sharp rebound like we saw in 2021 after the 2020 pandemic recession. But right, we can get an economy that starts to really recover if we get through some of these headwinds and get back to kind of a more normal supply environment, which means we have enough labor, right? People are certainly seeing higher wages, and that can kind of support better economic activity as we move forward.
All right, Rob Haworth, great conversation, U.S. Bank Wealth Management. We appreciate your time.
Thank you.